Okay? Now, just to put this in perspective, and I think why it's really come to light. Now, and I should add that this assumes, I'm making one really big assumption here, and that is that we're buying and holding, and that's all we're doing. So I'm buying the ETF, and I'm holding it for whatever duration we're talking about. I'm not doing any other, any rebalancing, any real allocation, which is really what you need to do if you want to track 2 times the period return. Okay? So if you're holding a position for a longer period of time and you want to track 2 times, if you started with $100, which gives you $200 exposure, if the market moves in your favor and now you have $240 of exposure, and you want to track 2 times the period return, you need to bring that back down to your $200 exposure. So you take money off the table. If it goes against you, you put more money in to bring yourself back up to $200 exposure. It's no different. Again, it just happens faster because it's daily. It's no different than your investor that's got 60% in equity, 40% in fixed income 2 years ago, and now it's flipped. They got 40% equity, 60% fixed income, but we know their strategic investment asset allocation should be 60-40 equity, fixed income. What should they do? They should rebalance back to that weight, right? It's the exact same concept. Yes? Thank you for that question. Do we have a spreadsheet, a rebalancing calculator on our website? And in fact, we do. It's a bull and a bear. You plug in the original amount you put in Beta Pro, what it's worth today, and the index move during that time period, and it will spit out the answer for you. I'll give you $20 later. Thank you. Here's the volatility idea here. And the point is, we know volatility is not our friend. The greater the volatility, two-way volatility, the further your returns will deviate from the 2 times period return, always to the worse. So you can see on the screen, as you in a bull and a bear, the math's different on the bears. But here's a really good example right here, this one. So the index goes down 20% in 1 year with low volatility, and I'll show you where 10% ranks. You're going to do more than 2 times. There's some compounding there. So it doesn't have to be a straight line move. As volatility goes up to 25%, you can see you're underneath 2 times the inverse return, but probably not unhappy. If you got 30 and thought, oh, period return of 2 times would be 40, but I understand the rebalancing. But look what happens when you crank up volatility to 50%. Not only didn't you track 2 times, the sign even changed on you. Right? So this is where rebalancing over long periods of time becomes very important for you if you want to achieve sort of period returns. Here's a real live illustration of oil and nat gas. These are 1-year numbers to February over February. And you can see that oil during this time period fell 75%, nat gas fell 60%. Look at the returns of HOD and HND. More than 2 times multiples, in fact, 6 times almost. Is that 6 times? 42, yeah, almost 6 times on oil, and certainly more than 3 times, almost 4 times on nat gas. There's your compounding in action, okay, because it was largely a directional move. All right? Here's the opposite when we're in a trading range market, and this is the benchmark that's most often used. These are gold stocks, second half of 2008. The index lost 2% during this time period we're looking at. So if you're in XGD, which is the iShares product that tracks global gold stocks, the index, you were down roughly 2%. If you were in our bull, you're down 42, and if you're in our bear, you're down 80, and that's because we had huge volatility. Okay? So the conclusion here, and I disagree with people that say our instruments are only for day traders. I think that's ridiculous, actually. To quote my 2.5-year-old over the weekend, didn't want to do something, and he looked at his mother and says, "Mommy, that's ridiculous." That was pretty funny. So, but I think what you want to do is you got to pay attention to what your economic exposure is and if it's changed. And if you get in a trading range market, you need to either rebalance your position or get out of the position. But obviously, you didn't day trade this and you made multiples of 2 times. So it's market path dependent. That's the key phrase. If you remember nothing else from today, and probably a few of you are sitting there and saying to yourself, I hope I remember nothing actually. Remember, period returns are market path dependent when you've got daily rebalancing and leverage involved. So there's where it works for you, and here's where it works against you. Again, both of them assuming you don't rebalance. I think if oil is going down 75% and you've got gains that are starting to measure in the hundreds of percent, if you don't take money off the table, you got a lot more guts than I do, and certainly the normal investor. You should take money off the table there. You should reallocate. You shouldn't let the bet, if you will, pile up on you. Annualized volatility, what has it been like? Well, here we are to the end of April. I think you'd be surprised to see that gold stocks are the most volatile. I've already mentioned that traditionally S&P 500 or S&P 60 is mid to high teens, so that's been double. And we know that the VIX got to 80 when it traditionally trades 20 or a little bit less, so 4 times what your typical volatility is. So when we get in that situation and you get in a trading range market, it's exaggerated in terms of the erosion from what would be an arithmetic 2 times period return. Okay? The rebalancing tool, the young lady up here mentioned. There you can see the bull and the bear. You need 4 pieces of information actually. The 3 I mentioned, plus you got to know if you're in a bull or bear. Okay? I'm half joking. Your assistant can do this for you. Plug that in if you want to know what the rebalancing is. Okay? Here we put this together to sort of come back at the critics saying that you just can't hold these for long periods of time. I showed you a 1-year number. But again, it depends on the path of the market. It depends on the degree of volatility during the time period. Here we're measuring May 2003 to May 2008. So in this particular time period, we've eliminated sort of the volatility of the last year, but we caught some of the volatility from, for about 15, 16 months since the beginning of 2007 was quite volatile. So, and you can see it reflected on the far end of the chart. And here you can see the 60 index. The index was up about 124% during this period. 2 times that would be 247, and in fact, HXU went up 334%. No rebalancing. Absolutely no rebalancing here. Okay? So there's a 5-year buy and hold situation where it worked out, again, to your advantage. You don't always, again, the line was, if you hold Beta Pro ETFs for long periods of time, you will always lose. That was the line. That is simply not true. Not true. Here's energy stocks. Again, you can see the numbers. Again, more than 2 times. You can see the volatility in it, but it's more than 2 times. And here's financials. Arguably our funniest ticker symbol, HFU. Now, so I got to be at least one laugh in this whole morning here. Our ETFs track extremely well on a daily basis. We show you the correlation. For periods longer than a day, performance is market path dependent. How do we get from point A to point B? Okay, this again is assuming you just buy and hold and don't do anything. And directional markets are favorable for the investor. You'll earn greater than 2 times or lose less than 2 times when a market trends. It doesn't have to be a perfect trend, just trending. And the greater the volatility or trading range, 2-way volatility, the further performance will deviate or be worse than 2 times the period's return. So when I start seeing comparisons of 1 beta mutual funds, long-term holds, to our products, which are daily rebalanced and have an investment objective of daily, you can use them for longer than that, just to understand how the math works. To quote my 2.5-year-old, I think that is a ridiculous comparison. Your apples and oranges are 2 different vehicles.